Hey everyone, Griffin here, and with 2026 just around the corner, there has never been a better time to put your money to work and start investing. Now, if you want that money to grow without turning investing into a part-time job and without drowning in confusing investment jargon, this video is for you. I'm going to walk you through exactly how I would start investing right now if I were a complete beginner, using what I've learned as an investor for over a decade now, while keeping it simple and realistic for you to implement. Here's how this is going to work. I've broken this video down into 9 clear steps, and by the end, you will know how to open the right accounts, what to buy, how much to put in, and how to keep growing your investments without babysitting them every day. Let's jump in. All right, so first things first, why would someone want to start investing in the first place? Well, if you've been saving money in a regular bank account, that is a great start, no doubt. But there's a big problem being inflation. And the thing about inflation is that it's pretty sneaky. You don't really notice it day to day, but over time, it quietly eats away at your savings, right? The $10,000 sitting in your account today might only buy $9,000 worth of goods in only a few years. That's the cost of doing nothing. And the only real way to protect yourself is by investing. The thing is though, when you invest, you're not just saving money, you're putting your money to work. You're buying ownership in real productive companies, businesses like Costco, RBC, Apple, or even Tesla that make products, earn profits, and hopefully grow over time. And as they do grow, your slice of ownership grows with them. That's the basis of how you outpace inflation and build wealth over time. But here's where it gets even better with a concept known as compounding. This is the snowball effect where your money earns returns, and then those returns start earning returns of their own as well. It's the single biggest advantage investors have, and it's why time in the market always beats timing the market, as even small, consistent contributions can build serious wealth. For example, if you invest $500 a month and earn an average of 7% per year, you'd have around $125,000 in only 10 years and nearly $500,000 after 25 years. Plus, once you hit that first $100,000 milestone, the next one comes much faster thanks to compounding doing a lot of that heavy lifting. So you don't need to treat investing like a second job. You can use simple automated strategies that grow quietly in the background while you focus on living your life and earning income in your career. Trying to time the market or buying the dip usually ends up backfiring. In fact, data suggests that if you miss just the 10 best days in the market over a decade, your total return can drop by more than 30%. So it pays to just stay invested and let time do the work. All right, from here, what investments should you actually consider buying and looking into to hold longer term in your portfolio? As realistically, this is where I see most beginners start to overthink things. Well, the good news though is that the smartest, most stable investments also happen to be generally the most beginner friendly. Here's a mistake I see all the time: individual stock picking before creating a solid foundation for long-term growth. New investors tend to scroll through the best performing stocks from the past year, maybe Tesla, Nvidia, Apple, and think, if only I had bought that one. Then they try to chase the next winner and often end up buying in at the top once a lot of momentum's already run through. And the problem is that the top performers are constantly changing in the market. Even professionals have a very hard time reliably predicting which companies will dominate next year, let alone 3 to 5 years from now. And if they can't, we as retail investors probably can't as well. And always keep in mind that money in the market, or any investment really, is made when you buy. If you're buying at the top, even if over years it's going to go up, well, that difference is going to be your profit potential. But someone who bought a year prior at $100 less a share is already materializing that profit when you're buying in. So always keep in mind that money is made on the buy, not when you're selling. So with this said though, it's much easier and historically far more successful for the masses to invest using index funds, or ETFs, short for exchange exchange traded funds. These are baskets of hundreds or even thousands of individual stocks grouped together. And by buying one share of an ETF, you instantly own a small piece of many different companies, spreading your risk while capturing the overall market's growth. And that's very powerful. Over the past century, for example, broad market indexes like the S&P 500 have averaged roughly 7 to 10% annual returns after taking into account inflation. It's definitely not a flashy investment, but it's steady and it compounds beautifully over time. Now, if you're in Canada, you can easily build a globally diversified portfolio using just a few ETFs. For Canadian positions, look into funds like XIU or ZCN. These track the Canadian stock market and include companies like RBC, TD, and even Canadian National Railway. For US positions, go with an ETF like VFV or XUU, which gives you access to big names like Apple, Microsoft, and Tesla, the global leaders really. And then finally, for a smaller, maybe global exposure, you could look into a position like XAW, which includes international markets like Europe and Asia. Now, if you're keeping things super simple, you can even go with something like VGRO, a portfolio ETF as they're called, automatically splitting your money between Canadian, US, and global market equities, while also including fixed income positions and rebalancing automatically for you. This is really the definition of a set and forget strategy, which is really great for most beginner investors. Okay, now before we move on, let's quickly talk about investment fees, because this is something that quietly eats into returns if you're not paying attention. ETFs charge what's called a management expense ratio, or MER for short. Think of this like a maintenance fee that's automatically deducted from your investments each year. For example, if an ETF charges a 0.20% management fee, that means that for every $10,000 that you have invested in that ETF, you would pay just $20 per year, which is incredibly low compared to, say, a mutual fund that can often charge a fee of 2% or more, which would equate to $200 in fees in this case. Now, over decades, those savings, though small year over year, can literally add up to tens of thousands of dollars. So always aim for ETFs with an MER under 0.5% and ideally even closer to 0.2% or below. You'll also come across terms like hedged and unhedged ETF positions. Although this might sound complicated, all this really means is whether the fund protects you from changes in currency value between the Canadian dollar and the US dollar. Hedged ETFs reduce currency fluctuations. Your returns won't move as much when the dollar changes. On the other hand, unhedged ETFs might fluctuate more, but they usually have lower fees and can benefit if the US dollar actually strengthens relative to the Canadian dollar. For most long-term investors, unhedged ETFs are perfectly fine. You'll get natural diversification through currency exposure and lower costs as well. So to sum up this section, avoid chasing individual stocks, at least in the beginning, before you have a solid base of broad low-cost ETFs. Next, you need to know where to hold your investments, because in Canada, the account you choose can matter just as much or even more than what you invest in. The reason I say this is because this is going to determine how your money is taxed, how much profit you actually keep, and what rules you'll need to follow while investing. The good news though, you really only need to focus on 3 main accounts here in Canada: the FHSA, the TFSA, and the RRSP. The FHSA is short for First Home Savings Account. This one's designed specifically for first-time home buyers, and it's one of the most powerful new tools available to Canadians. Essentially, you get a tax deduction when you contribute, just like an RRSP, and then tax-free growth if you use the money to buy your first home. You can contribute up to $8,000 to your FHSA per year with a lifetime limit of $40,000. And if you never end up buying a house, no problem, you can just roll that balance into your RRSP at a later date, keeping all of your tax advantages. In short, it's really a perfect first step if buying a home is anywhere on your radar over the coming years. Next is the TFSA, short for tax-free savings account, which despite the name is actually not a savings account really. It's actually one of the most flexible investment accounts available in Canada. So inside a TFSA, any growth, whether it's capital gains, dividends, or interest, is going to be completely tax-free. That means if you buy an ETF, let's say like VFV, and it goes up up 50% over time. Well, you owe zero tax on that amount when you sell. You can also withdraw your money anytime without penalties, and whatever you take out is just added back to your contribution room the following year. Each year, the government sets a new limit, by the way. For 2026, it's expected to be $7,000, bringing the total lifetime limit for someone eligible since 2009 to over $100,000. So the TFSA is really incredible for long-term investing, side portfolios, or building wealth tax-free alongside your regular income. And third, the RRSP, a classic Canadian account built for retirement specifically. You get a tax deduction when you contribute, which reduces your taxable income for that year. For example, if you earn $80,000 from your job and choose to contribute 10 grand to your RRSP, you'll only be taxed as if you earned $70,000 that year, instantly saving you hundreds or even thousands of dollars in taxes, depending on which bracket you're in. The trade-off here is that you do pay tax when you withdraw later on down the line, but since that usually happens in retirement when your income and tax rate might be lower, it still ends up being a smart move. In my view, here's a simple order of priority for which accounts to use in sequence. If you're just starting out and don't yet own a home, start with the FHSA, then the TFSA, and finally the RRSP. That order gives you the best mix of flexibility, tax advantages, and long-term growth. Oh, and one last little thing to keep in mind here, US dividends paying stocks like Apple or Microsoft follow slightly different rules depending on the account. In a TFSA, you'll pay a 15% withholding tax on US dividends. But in an RRSP, you do not pay any withholding tax on US sourced dividends thanks to the Canada-US tax treaty. So if you plan to hold US dividend ETFs or stocks specifically for that income, it can potentially be a smarter move to keep those inside your RRSP instead of your TFSA. Next, let's talk about how to actually buy your investments once you've picked your ETFs and chosen the account type that you'll start investing in, which is where a brokerage platform comes in. So choosing a brokerage in Canada can feel a little bit overwhelming potentially because there are quite a few options out there, but really it comes down to a few key things to consider. Number one, low fees. So first off, keep your fees as low as possible. You don't want to pay $10 every time you buy or sell an ETF. That adds up fast, especially if you're contributing monthly. Look for brokers that offer free or low-cost trades, so more of your money actually goes towards investing, not commissions to the brokerage. Two, make sure the platform supports all of the key accounts like the TFSA, RSP, and FHSA. Not every broker does, and if it doesn't, that could be a deal breaker. You want to be able to buy, hold, and manage everything from one place without juggling multiple apps. So considering those main criteria, that is why I would personally recommend checking out Moomoo. This platform checks all of the boxes: access to both Canadian and US markets, support for the TFSA and RRSP accounts, and a really intuitive platform that's beginner friendly but still powerful for more experienced investors, with all the amount of data that they allow investors to access completely free of charge. Plus, right now you can sign up using the link down below in this video's description and pinned comment to get the best available sign up offers. So if you're ready to start investing and want to avoid unnecessary fees, it's definitely worth checking out. Once your account is open, your ID is verified, and everything is linked up, the next question is, when should you start investing and how much should you actually invest periodically? This is one of the biggest sticking points for beginners. So here's a simple two-step checklist that I always use before putting any money into the market. Step one, if you have any high interest debt, especially credit cards, make sure that that is your top priority before investing. Paying it off gives you a guaranteed risk-free return. Think about it like this: if your credit card charges 20% interest, paying it off is the same as earning a 20% return in the market. Instantly though, and with zero risk. There is really no investment in the world that can 100% guarantee you that kind of return consistently. So clear that first before investing heavily. Step number two, make sure you've built up a proper emergency fund, at least 3 to 6 months of living expenses in a high interest savings account or a money market ETF. This is your financial cushion if you lose a job, have an unexpected bill, or your car breaks down, for example, and it prevents you from having to sell your investments at the wrong time or go back into debt just to handle an emergency. And then step 3, you're ready to start investing. And the truth is, you can start with really any amount. Even $50 or $100 a month is definitely more than enough to begin. The key isn't how much you start with, it's how consistent you are. Pick a fixed day each month, automate your contribution, and just let it run in the background. Dollar cost averaging simply means investing a set amount of money on a fixed schedule, no matter what the market is doing, up or down. Sometimes you'll buy when prices are a bit higher and sometimes when they're lower, but over time, DCAing averages out, helping reduce your risk and your stress as well in investing. Additionally, it protects you from emotional knee-jerk reactions to the market, like panic selling when markets drop or jumping in blindly because you saw something trending on social media. But truth be told, above all else, the real secret is staying consistent with your investments. Focus on slow, steady growth, not chasing hype or timing the market. If you keep investing through the ups and downs, your money compounds quietly in the background, and that is really how long-term wealth is built. Plus, always remember that once a dollar is sent to your asset column, being your investment portfolio, you never want to take it out, as this slows down growth and limits compounding. As a quick example to show you how compounding really does work, here's a quick example of the VOO ETF that I hold in one of my investment portfolios. As you can see here, the average book cost is far below what it is worth today, and that is because I've been buying that over time and it is compounded to be worth quite a bit more than when I purchased it. And there you have it. That's really everything you need to know to start investing from scratch in 2026 as a complete beginner. Just keep it ultra simple, use the right account, stick to broad low-fee ETFs at the beginning, automate your contributions, and let time and consistency do the heavy lifting. Also, if you're really committed to learning more about DIY stock market investing, I'd recommend you check the link below over to my Skillshare course. It is completely free on a 1-month free trial, has over 7 hours of content and over 3,000 students, which is absolutely insane to think, and it will cover everything you need to know about confidently navigating the stock market as a beginner. So with that said, thanks a lot for watching. Make sure to leave this video a like, and I'll see you in the next one.